Welcome back. Our insurance companies in Kenya are fine-tuning the modalities of meeting the June 2018 deadline of implementing a risk-based capital model approved by the government. In its latest report on Kenya insurers, analysts at Exotics Partners tried to explain how the risk-based capital will work for non-life business. Now, let's talk to the author of this report titled Risk-Based Capital, Time for a Regulatory Upgrade, Moma Ismaili. Moma is an equity analyst for Exotics Partners, London. Good afternoon, Moma.
Good afternoon.
Now, just give us a general assessment of the insurance sector in Kenya.
Yeah, well, it's pretty much a bright spot in sub-Saharan Africa. As you'd note from the note that you probably received, that the regulatory framework has developed far ahead of the other countries in East Africa and probably West Africa as well. The penetration rate is also relatively higher, currently at almost 3% compared to a sub-Saharan African average of around 1%. So I think the insurance sector in Kenya has progressed extremely well over the last couple of years, and we see developments, especially around the regulatory front, to suggest that progress will continue, probably even at a faster pace over the next 5 years.
Now, your report titled Risk-Based Capital, Time for Regulatory Upgrade, what is it all about?
Historically, the insurance companies in Kenya have had these very lenient capital requirements. So, the way we look at it is almost anyone can operate as an insurance company. The minimum capital requirement is very low, and the solvency requirement is the same for all insurance companies, regardless of their risk profile. Now, what we talk about in the note is the introduction of a risk-based capital model that focuses on company-specific risks. So you may have an insurance company, for example, that has a high exposure to equities, which is a volatile asset, or an insurance company that has a huge concentration in one line of business, for example, medical or automobile. So what the risk-based capital model does essentially is focus on these risks and ask the insurance company to raise a little more capital for that specific risks. So ideally, you look at the varying risk profiles of each business, and each insurance company will have a different capital requirement based on their risk profile. And that's basically what we discussed in the note.
Now that the government seems to have approved this risk-based capital model, which is expected to be implemented come June 2018, how do you think this will work for non-life businesses?
Well, I think the non-life businesses are expected to react in three particular ways. So the first is they're going to probably restructure their balance sheet. I mean, you'd find that a large component of the risk-based capital model actually focuses on market risk, and the bulk of that is your investment assets. So in order to improve their capital adequacy, they'll probably have to restructure the balance sheet, and by that I mean maybe sell a few assets or transfer assets from the non-life business to either the life business or a holding entity. And then the second thing is to improve their collection, the average collection turnaround. So like Nigeria and Kenya, we've historically had a problem with receivables or bad debts. And in the new RBC model, and it's also been a feature of the old model, the receivables receive 100% capital charge, which means that they're totally inadmissible when you're calculating your risk-based capital. So what the insurance companies would have to do is ideally reduce the amount of receivables. So we expect them to improve on the average collection turnaround, which means tighter credit terms. Instead of giving an intermediary or policyholder 60 days to pay, you'd probably give them 30 days to pay. The last and final thing is consolidation. So we expect a lot of consolidation with the insurers with a small market share. Because we just believe they won't really have the capital to meet the new capital adequacy ratios. But we don't think it will be a large sort of regulatory induced consolidation. Maybe just a few local consolidation here and there.
All right, thank you very much for your time, Moma. That was Momar Ismaili. He's an equity analyst and at Exotics Partners, London. While still in Kenya, Uber drivers there in capital Nairobi went on strike and held a march on Tuesday to protest against reduced fares effected by the company. Uber operates in several African countries, including Kenya, where it launched in early 2015, drawing customers by offering lower prices and cutting out haggling over fares.
The US-based firm, which started operations in the East African country in January 2015, is cutting total fares by up to 35% to boost demand for the service amid growing competition from local firms.
The reason we are here, it's because we have been grieved, and it is about the issue of cutting fares. And being a driver partner, I was not consulted. And that is one of the major reasons why we have decided to come on the street. Not because we don't love Uber. It's a good company, it's a good technology company, and we love working with it.
He says drivers were considering signing up with other ride-hailing companies like Little Cab, which was launched last month. There are at least 3 ride-hailing apps in Nairobi, and the services have not spread beyond the capital, heightening the scramble for customers. Uber, which allows users to book and pay for a taxi by smartphone, said the cuts were in the driver's interest as they would attract more customers, adding that it consulted with its drivers before cutting prices. Uber dropped the price per kilometer to 35 shillings from 60 shillings last week. It also cut the waiting rate per minute to 3 shillings from 4 shillings previously. Uber users in Kenya say regular taxi cabs have raised their fares in response to the strike at Uber. The drivers say they would all switch to Little Cab if Uber does not accede to their demands. Little Cab, which is jointly owned by telecoms operator Safaricom and local software developer Craft Silicon, was launched on July the 5th.
Let's now cross over to Nigeria's interbank forex market. Austin Okpala, FX dealer at UBA Group, joins me now. Good afternoon, Austin. Hello, good afternoon, Austin. So tell me, how's the Naira faring today? Oh, we seem to have lost Austin there. And Ghana's parliament has overwhelmingly rejected a key tenet of a $980 million aid deal with the International Monetary Fund, breaching the terms of a 3-year program meant to fix an economy dogged by high public debt. The members of parliament passed the Bank of Ghana Amendment Bill to allow central bank financing of the government's budget deficit up to a ceiling of 5% of the previous year's total revenue instead of the zero financing demanded by the IMF. Well, Austin, good afternoon. Thank you for joining us.
Good afternoon, Jumake.
This is Chimeze. Well, tell me, what's the state of the Naira right now?
The dollar Naira is trading at 315 Naira 50 kobo to a dollar.
And what is the current state of liquidity? Is the CBN, has the CBN intervened today?
CBN has been intervening every day in the market. Even today, they just called now. They've been intervening, and the liquidity in the market has been improving since last week, after the MPC.
Okay, so with what you have seen so far, do you think the Naira will eventually appreciate any further than what it is now?
Since Monday, the Naira has been trading below 320 Naira to a dollar. Given the inflows and the foreign investors, their interest in the market, I think very soon we'll see a stable market, a stable Naira in the interbank market.
All right, thank you very much for your time, Austin. We'll take a quick break now. When we return, we'll look at the activities at a fixed income market. Do join us again.